Welcome everyone to today's Cake capital raising session. Thanks for tuning in. My name's Jason Atkins. I'm one of the co-founders of Cake. Personally, I've run 5 capital raises in the last few years, and at Cake, we've helped thousands of companies to prepare for, run, and close their capital raises. We've got about half an hour today. We're going to cover quite a wide range of topics. So yeah, maybe just concentrate on the things that are most relevant to you. So let's do it. So at Cake, we're really focused on cap tables that are easy to use everywhere. So what we've done is we've simplified the technical aspects of running a capital raise. We've removed many of the manual steps. We've reduced a lot of unnecessary communication, and we're really only getting started. Today, we're going to focus on an overview of what a capital raise is, some rules of thumb. Many things around capital raising, especially in the early stage, can be hacked through and done in a very simple manner, can be really overcomplicated by founders. So these rules of thumb are going to be really helpful for you. We are going to do some technical stuff. It's a really important financial and legal transaction. So we're going to cover some of the real technical aspects of a round. And we're going to talk about where and how to pitch and who to. Let's do it. So many of you guys are going to be in this valley of death. So in this very early stage, before you've broken even, you're going to be raising from angels, friends and family. You're doing your seed round. Some of the really early stage venture firms are coming into this very, very early stage raises. But more traditionally, your VCs are going to kick in around your A round, your Series B, and so on and so forth. Today, we're going to focus on, from the very beginning up to the Series A. There is a lot of capital around at the moment. Here you can see in Australia, the amount of venture capital that's available. It's been increasing year on year, for quite some time. They've all raised a large amount of capital in the last 12 months. So it's a really great time to be a founder, especially once you get through those first couple of rounds, you get to Series A, you get to Series B. It's quite important as well when you're raising to realize that there is a market out there. And even though you may be new to capital raising, investors are seeing lots of deals. And the more you can fit into these buckets, the greater chance you have of your round happening quickly and smoothly and not getting blocked along the way. So pre-seed used to be called friends and family. Friends and family can sometimes happen before this, but essentially this is the first bit of real funding that comes into the company. Normally you're looking at $1 to $3 million valuation. You're raising about 10% of the ownership of the company. So you're diluting about 10%. And you're raising sort of 200 to 400,000. During this round, quite often implementing an ESOP as well. So around 10% of the equity of your startup will be allocated to employee share option plan. Once you get through the pre-seed, then you get to your seed. So as you can see here, the valuation goes up. So from 1 to 3 million, now $3 to $5 million valuation. That's your pre-money valuation. So the value of your company before the new capital comes in as part of your round. You're diluting a little bit more, so 10 to 20%. And it can be good to think of the pre-seed and seed as one round when it comes to dilution. So you're trying to keep the dilution, so the amount of equity that's going out to new investors, to between 20 and 30% for both pre-seed and seed. You can see here with seed as well, the amount you're raising goes up, 500,000 to $1 million. And you're probably using the same ESOP as your pre-seed all the way through your seed. I should point out these are rules of thumb. Some industries are hotter, some companies are more progressed. Fintechs and certain sectors do attract high valuations and larger raises. Sometimes larger investors like VCs will come down and participate in these earlier rounds, and that will allow the valuations to be a bit higher potentially, and the raise amount to be a bit higher potentially. But it's best to understand these buckets, these categories of round quite clearly, because it is going to help you to get through these without getting stuck on any of these things. So now you've got through pre-seed and seed, your company's progressing along really well, your valuation ticks up, you're diluting again a bit further, another 10 or 20% in your Series A, the raise amount increases, and you're probably implementing a new ESOP at this point as well, because it's most likely that the first ESOP has been fully allocated to your team members up to this point. I'm just going to quickly now touch on dilution. So it can be a bit tricky for founders quite often to understand dilution. It doesn't really feel great when you're owning less and less of your company as you're going through the rounds. But the idea is that, so here when you have 30%, this company's got a pre-money valuation of $4 million. So 30% of $4 million versus 12% of $100 million. So even though the equity that you own has diminished throughout the rounds, the value of that equity has gone up significantly. So friends and family tips. So focusing on rules of thumb, not details. Many founders will go, they'll build a big complicated financial model, they'll do a complicated valuation, they get really stuck in the details. This is really unnecessary. You need to look for hacks to minimize the amount of money you're spending and the amount of time you're wasting. For example, the Burkas method valuation. The Burkas method can be done in as little as 5 to 10 minutes and gives you a universally understood valuation for the very first round. Be professional with your sweat equity. If you have people helping you out and they're getting equity in your company, make sure there's an agreement in place. You can use your ESOP for this in most cases, so you get a really good agreement in place, which allows you to build trust with the people working with you, as opposed to, the alternative where there is an agreement, it's just a handshake, things don't necessarily go well, that works against you as a founder. So make sure you value your equity. You do hear a lot of founders early on say startup equity is not worth anything. If you don't value your equity, then who will? So make sure, even if it's 1 million, 1.5 million, 2 million, whatever it is in the beginning, give it a valuation, treat it with respect, and talk about how you're going to increase the value of your equity over time. Probably the last one I'll point out here is building quality relationships. It is really important to start very early building your investor relationships. These people go with you normally on the whole journey, over 5, 10, 20 years. So spend the time, learn your ecosystem, learn who's going to invest, and start building those relationships early. So then you get to your seed round, things start to professionalize a lot more here. There is a market, as I talked about before. There's expectations for where your company should be at, where your product should be at, where your revenue should be at. So make sure you're aware of where the market's at before you go out and try and raise your seed round. There starts to become multiple valuation methods at this point. There's discounted cash flow, revenue multiple. So really start to understand those 3 or 4 different types of startup valuation that you can use. Cake has a valuation dashboard that you could hit us up for. You can still do those valuations very, very quickly, very simply, but there are multiple methods. Casting a wide net, I quite often see startups working with too few investors. Make sure you've got 10, 20, 30, 40 investors that are aware of your startup, that you're communicating to, so that when your round opens up, you can work through discussions with those investors as quickly and efficiently as you can to getting your round done. Another thing here as well, just to remind you guys of, is make sure you're selling your company, selling the equity and not your product. You don't want to be out there pitching your product to investors. You want to make sure that you're talking to them about your company, the deal, how your company is going to go up in value, and those sorts of things, as opposed to what your product does. Of course, your product is important, but in these very early stages, the investors are much more investing in you as founders and the vision and your ability to just tackle that problem over time. Your product is probably still fairly dodgy at this point. What have we got next? Oh, founder tips. So I guess this is just more from me to you guys. Look after your health and your mental health. Being a founder is super challenging, and when you're raising capital, it's like a full-time job on top of what is already a difficult challenge in finding product market fit. So if you've got a couple of founders, allocate one to capital raising and one to the rest of finding product market fit or whatever you're doing with the product in the beginning. But really look after your health. Look to accelerators and incubators, especially first-time founders. They're a wealth of knowledge. The networks are incredible. There's normally investors around those accelerators and incubators as well. So do your homework, find some good networks to get into. Definitely connect into your purpose. You know, why are you doing this? Is this your life's mission? It helps to keep you powered up. It helps to get investors on board, bring team members on board. You know, if you're really doing something powerful, it's much easier to get supporters. And, you know, that's a big part of startup life. I guess network and brand ties into that really well. Keep building your network, keep building your personal brand and your startup's brand. Make sure people believe in what you're doing. It's super, super important. And look, learning and keep learning. I thought I knew a lot before I started, but you know, doing startups and literally the amount that you have to learn every 6-12 months is crazy. And unfortunately, once you learn everything, then you need to relearn the next set like over and over again. So just be really, really great learners and never have a closed mind as well. All right, so what do investors want? So this is a bit of a tricky one, I find. Quite often you're talking to investors and they want to know what's going to happen in the next 12 months and they need to feel like it's really tangible. But they also want to know how you can become a unicorn. I know the first few times I was pitching, it was a really big challenge to be able to articulate both those things. So one way to do it is to think, all right, well, how do I show the investor that in the next 12 months, my startup's going to go from being worth $2 million to $4 million or $4 million from $8 million? And how am I going to hit the milestones that are required to sort of take those steps? And so you can have reasonably intelligent conversations about that, even with only having the limited knowledge that you always have in startup land. Then, you know, the bottom one here, you need to talk about the 20 times return. So this is where you start to talk about your vision, the big picture, where your startup's going to be in the long run. And you need to be able to tell both those stories to be able to get the investors to want to engage and come on the journey with you. So this one here, I guess, is about thinking about this as a sales and marketing game. It is a financial transaction, but you need to think about selling your equity as marketing and sales. So do your investor research, find out which investors invest in whatever niche or industry you're in, at the stage of the company you're in, find out who's actually active, so who's really investing at the moment, do that work. Make sure you have a great list. If you need $500,000 and the average check size in your market is say $50,000, you need 10 investors. Therefore, you probably need 30 or 40 investors that you're talking to so that you can actually get those 10 investors when the rubber hits the road. And it's not to say that the other investors don't want to invest. There's just lots going on in these guys' and girls' life, right? They've got they've got other startups to do. They've got other deals on their hand. Might not, there can be a whole range of reasons why they won't invest. So just make sure you got a really great list. When you're pitching, beat the next best alternative. Make sure your pitch is strong. Test that out before you actually start going and having your investor meeting. So try and get all the kinks and bugs out before you really open up your raise, which I guess comes on to the last one there. Get feedback and really be ready when you go. Cool, so some technical stuff. It's not very fun. If you're not an accountant or a lawyer, it's really hard as well, so I do apologize about that. But it's also super important. If you don't get this right, you can lose millions in the long run by being over diluted. You could have some really crappy terms in your term sheet that actually mean you don't have control of your own company, even in a really early round. But don't be scared of it either. If you're scared and you're negative, you go into the discussion that way, the investors can feel that. You need to find a professional balance around this technical stuff that shows that you're confident and competent, but you're protecting yourself and your company. So on day one, get a company. You can't have trust or anything like that in startup land. Make sure your founder equity is split correctly. If you've got one person working full-time and the other one's just working like 2 hours a week and you've got a 50-50 split, it's gonna come back to bite you. You guys are not gonna get along at some point in time, I guarantee it, and the investors are gonna see it as a red flag. So make sure you got a founder agreement based on contribution. Make sure there's vesting on that. So if one of the founders leaves, you know how to get their equity back and how you're gonna do that. It's really quite important. Quite often, get yourself an ESOP like straight away. Can be really good for founders, for advisors and your first hires and stuff like that. And of course, get on K, because the first 5 investors is free and there's heaps of amazing stuff in there for you, like subscription agreements and con notes and safes and a whole ESOP and everything like that. So it's going to save you a ton of time and money. So I highly recommend that. This is one of the questions that you sort of have to solve in Australia, definitely. Think in the UK, not so big. US, definitely. Singapore, definitely. New Zealand, definitely. So, are we going to do a priced equity round, or are we going to do a con note or a safe? Convertible note is essentially a loan from the investor to the company that converts to equity later. That later is normally when you do your next round. So if the next round is say 5 million pre-money valuation, convertible note will convert into that next round, normally at a discount to the 5 million. So maybe 30% discount, 20% discount, whatever. A safe is very, very similar, where the investor gives the money to the company. It's not technically a loan, but it does still convert to equity when the next round happens. You can have different conversion terms, but I think 90% of these con notes and safes convert into the next round at a discount to the price of the next round. So really, really common. The reason why you do them, you don't have to worry about evaluation, which can be really tricky early on. The legal costs are a lot lower. The legal complexity is a lot lower. You don't have to settle. Like if you do an equity round, you have to settle it all on the one day normally. So you're talking, lawyers, trust accounts, lots of documents being signed on the same day. You have to reach a minimum before you can actually close the round. Whereas with a convertible note or a safe, you can raise, part of the round 1 month and part the next month and part the next month and so on and so forth. And as a busy founder, it really is a godsend to have that flexibility. So these are some of the terms that you're going to see in the term sheets coming in from your investors. At Cake, before we did our seed round, we had to sit down as founders and go through these one after the other, and it really does take some time. So take the time, invest in it before you run your round. If you get a term sheet from an investor and it has all this stuff in it and you've never seen it before, it's going to be really hard for you to understand it all quickly enough. Trust me, it's really technical and complicated. And what you might do is get one of these wrong, and that can, as I said before, cost you millions in the long run from a dilution perspective. It could, for example, with this drag-along clause here, allow the investors to sell your company without your permission. So yeah, get around these. Go to the, in Australia, go to say something like the Airtree open source term sheet. I know in sort of the, in the UK, they have I think it's the British Venture Association. They have a term sheet open. So just read through all the terms, kind of get to know it. It's going to help you a lot in the long run. There are some things to try and avoid as well. Liquidation preferences with multiples are really going to hurt you. Sometimes founder vesting can be tricky. And make sure you've done your modeling, your round modeling, managing your voting. So make sure you've always got a board seat. Make sure you've done your consents for your round and stuff like that as well. Cool, so this is a couple of areas that sort of Cake specializes in. And they're actually 2 of the key components to your due diligence. So when an investor's keen to invest, they're going to want to see your cap table, and they're going to want to see, how the overall cap table looks, once the round is finished as well. So who owns what equity before the round, what actually is happening in the round, and then what's happening after. So you got to consider things like, have I got convertible notes before the round that are going to convert at a discount, and then how much equity is that going to be after the round? Have I got an ESOP? Am I making a new ESOP? What's the share price before the round? What's the share price after the round? There's quite a lot to be done between these 2 things. And if you haven't got it done and you go to the investor and you pitch and they're interested and then they ask for this and you can't give them anything, at best, you're going to have a delay of like a month. And at worst, they're going to run because you haven't been professional and they're a bit nervous that you're not competent. So, In Australia, we have ASIC, so wherever you are, make sure that the regulator is in sync with your cap table. Your investors are going to go and look and see, and if it's not there, then they're going to lose trust that you can keep it up to date after they invest, right? Sometimes you need to do a share split. You might only have 100 shares, but you need to do an ESOP, and around you might need 10 million shares. So get that split done. You know, are you going to have preference shares over ordinary shares? Do you even know what that is? If you don't, you know, you've got to start learning those things. Sometimes you have 2 or 3 lots of preference shares. It's called a waterfall with the ordinary shares underneath. You really do need to understand all those things. And you need to get approval to run your round. If you haven't told your current investors that you're going to run around and you haven't sort of warmed them up, you know, you might find you get a great investor and you get great terms, but your existing investors aren't even going to sign off that the round can go ahead. So it really is important that you get these cap table things all sorted. Modeling, look, it's potentially even more important. You know, what are the deal terms? Do you really understand them? Dilution's probably the critical one. You know, it's not very simple maths. And if you look at how it goes through the rounds and how quickly you can be diluted, you know, you can go from, you know, the founders owning 90% to the founders owning 30% in a matter of 2 or 3 rounds, which is fine if you've planned it that way and you've, you know, getting the value creation that you want, but it can really work against you if you haven't modeled it out correctly. So I would normally advise, you know, at least model out 2 rounds forward from where you are today and have a really good roadmap of how that's going to unfold. Convertible notes can be tricky. So I was talking to a founder the other day and they said, oh, well, we'll just do a $500,000 convertible note, a 50% discount into the next round because we think we're going to have a really high valuation on our next round. I said, oh, that's great. But what happens if you don't have a high valuation on that next round? 50% discount's a really big discount. So if you happen to have like a flat round or a down round, and then you've got a 500K conversion at a 50% discount, you know, you're really going to dilute yourself really hard. So, you know, looking at the con notes, just checking that they do sort of operate how you want them to, maybe check how they convert at different valuations once you're modeling out a couple of rounds ahead. Of course, make sure you're including your ESOP in there. It can really save you a ton of money in the long term. I don't want to see founders, you know, getting to Series B and C and regretting these mistakes early. And I must say as well, like, we're not immune to that at Cake. You know, we're currently doing our A round and there's been a lot to learn. You know, we're in good shape, but I think we could have done better. And so, you know, hopefully you can as well. Cool, so ESOPs, yeah, so somewhere in the 5 to 15%. So that allows you to get your advisory board set up, your first hires done. You'll normally run out somewhere around your A round and then you can look to top it up again. So you can just keep topping that up via a resolution. All right, so moving on to the final stage. How am I going for time? Pretty good. So as I said before, the most important thing when you're running your round is where you're going. I'm just going to get myself back on screen just so you can really feel how important this is. So if you can't clearly articulate why you're awesome, why your startup is awesome, where you're going, and the fact that your problem is worth solving, then you're going to have a really hard time. So dig into this, be purpose-led, super critical component. So, you know, 2 of the best VCs in Australia, in the world, you know, Blackbird and Airtree, really highlight this here right on their homepage. And don't forget a bit of FOMO. If you're running around and you're out there talking and there's no energy and you don't have lots of investors in your round and it's not closing, it's really hard to make investors make that decision that they're gonna get on board. So make sure you really keep a bit of energy around your round all the time. All right, pitching. So you want 2 decks. You want a marketing deck. It's 10 slides. It's super high level. It's emotive, big text, not a lot of words on any of those slides. The goal of that deck is to get your partner meetings. Then you have your pitch deck. It's 30 to 40 slides. There's much more context in there. Maybe some, you know, really detailed stuff in an appendix. That's the one you pitch at the partner meeting, and the goal of that is to get the term sheet. It's very important to get a lead investor. It's almost impossible to run around without a professional or well-known angel, so a professional investor like a VC or a very well-known angel to lead your round. If you can't get a lead investor, you can still run a bridging round. It was normally, somewhere in the vicinity of, 20 to 50% of the round that you wanted from a size perspective, and would normally be run by a convertible note or a safe to give you the capital that you need to get to your next full round. Now, due diligence as well, so be prepared. You don't, as I said before, you don't want to get into the meeting and it goes really, really well. And then the next minute they say, cool, show me your data room. Actually, this has happened to me, sort of. I was half prepared, but it's really, really hard to catch up. You don't have to go with any fancy software necessarily. A Google folder works pretty well. And we've got a checklist provided for you if you need it, so you know what to put in there. You should roughly raise about as much capital as you need to hit your next set of milestones. So if you're doing your seed now, you need to work out what milestones you need to run a Series A, which is quite often 1 million in ARR or thereabouts. It should be about 12 to 18 months of capital for you. Do be wary of over dilution as well. So as I said before, 10 to 20% per round is about right. And with your forecast, don't necessarily do a big complicated one and have the hockey stick slide in your pitch deck, because pretty much every pitch deck has it, and you can just take the company name off one and stick it on another and put it in any deck. Valuations, really, really tricky for founders. I think I'm noticing some improvement in general in the ecosystem about this. The simplest thing to do, and if your investors are happy to do this, is to say, well, I need this much capital to reach the next milestone, and I can't dilute myself more than 20%, and you calculate the value, the pre-money value of your startup that way. You should also, ask around, check out what's happening, look at the trends, see how you fit in the boxes. You can't just say, oh, I need $10 million, therefore I'm worth 40 million pre-money for a seed stage company, right? So you need to understand where the market's at. And these sorts of things is normally how you jiggle your valuation into an area that's acceptable and reasonable between the startup and the investor, and how much dilution you want to do in each round. There is a pretty cool piece of software out there called Equidam. It's got tons of global data. There's a qualitative and quantitative section. I really like it. And so you can check that out as well. It's also very normal to not set the price. So you will say how much capital you need and what the milestones are, and then you'll normally get a lead investor, whether it be a stronger angel or a VC, to give you a term sheet and actually set the price for your round. So right in the beginning, you're bootstrapping, you're doing your friends and family in your pre-seed round. So it's founders are kicking in, they're doing sweat equity, your team, your advisors can be kicking in both cash and sweat equity. Friends and family, look, not everyone has friends and family that can kick in cash, but you do need to kind of try and find people that can trust you, that can give you some capital. It is a stepping stone, towards getting further capital later. Definitely run it as a side hustle. You do need to validate your idea and your MVP or your prototype or whatever to a certain degree before you can go out and actually ask, arm's length angels for capital. Make sure you do some investor marketing as well, because when you get to the next round, these guys are much more professional. They still do want to help you, but you need to be at a certain level before they're going to be able to engage. So there's tons of angels out there now. It's increasing all the time. There's lists out there in every market that show you, who's active, what niche they invest in, what industry, what stage, and all that stuff. So get out there, make your investor list, and get pitching. Again, tons of VCs around at the moment. The space is really growing in momentum. Lots of the venture capital firms are hiring more people, so they have more capacity to see more startups and do more deals. So the faster you can get your startup to venture capital land, the better. There are requirements and stages that you need to be at to get venture capital, but working backwards from the sorts of things that they want to see is a really smart way to think as a founder. There's also platforms and advisors in every market. So crowdfunding for the earlier stage companies to, your more pre-IPO capital raising platforms, and advisory groups as well. Venture debt is increasing in popularity all the time for those companies that are a bit more progressed and have that ARR, kicked in and growing. So there's a bunch of resources here as well. Everything from open source documents, from term sheets to investor lists, Medium posts, how VCs look at startups. So check that out when you get a chance. So thanks for joining us. That's the end of the session today. Hit us up for more information. We've got tons of tools around valuation, building your investor list. And of course, check out the Cake software. It really is designed to streamline and simplify your round. And happy raising.